Welcome to the Sidebar with a CFP. Pierce the veil on BigLaw Life, career, and money. Hosted by Matt Smith, the tour manager for BigLaw attorneys. You bill in 6-minute increments. Let's get you some of that time back. In each episode, we will have candid conversations about life inside Big Law, the real stuff they don't teach in law schools or show in recruiter brochures. This show pulls back the curtain on what it actually feels like to climb the ranks, navigate transitions, and make big decisions in a high-stakes career. You'll hear from partners, associates, and experts across law and finance, each sharing stories, surprises, and strategies for building a life and career that works for you. This isn't a money podcast. It's a Life in Big Law podcast with a CFP in the host chair. The contents of this podcast are purely intended to be general and educational in nature and should not be construed as specifically tailored investment, financial planning, tax, legal, or other professional advice. Any investment performance referenced is purely past performance, which is no guarantee of any future performance. Nothing contained in this podcast should be construed as an offer to sell, a solicitation of an offer to buy, or a recommendation of any security or other financial product or investment strategy. All investment, tax, and financial planning strategies involve risk that you should be prepared to bear. You are highly encouraged to consult with professionals of your choosing before taking any action based on the contents of this podcast. To the extent the guest on this podcast was a client of Concert Financial Planning as of the date of the recording, the guest was not compensated for their time. Nothing conveyed by the guest should be construed as a testimonial or endorsement of Concert Financial Planning, and their experience as an investor or a client may not be representative of all investors or clients. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, iHeartRadio, and on our website, concertplanning.com. Now here's the host of Sidebar with a CFP, Pierce the Veil on Big Law Life, Career, and Money podcast, Matt Smith.
Hey everybody, welcome back to Sidebar with the CFP. Today's episode is going to be a continuation of the episode we did last month where I started to explain what a futures contract is. And so if you haven't seen that prior episode, it's pretty important that you do. You don't necessarily have to watch it if you want to just listen to the audio. That should probably be enough. But I want to continue explaining the evolution of futures contracts and why I'm even talking about them, how they impact our investment lives. So as just a real quick reminder, we established last time that a futures contract is just jargon for saying that one party is going to agree to buy or sell something at a specific price on a specific date. And so in the example we use the example of a farmer because we wanted to talk about how futures contracts came into existence in the first place. They actually serve an economic purpose. If a farmer is growing corn, like in our prior example, they have to plant the crop in the spring sometime, let's just say May. They're not going to be paid for that crop until the harvest comes and they've been able to sell their corn harvest to the factory that uses corn for whatever purpose, making cornflakes, making ethanol, whatever it might be. And so the dilemma is the farmer doesn't know what the corn is going to be worth once it goes to market to be sold in October. And the factory that is going to buy the corn doesn't know what price they're going to have to pay until October. And they would both like to have more predictability and more price certainty. And so they will simply agree back in May. The farmer and the factory will get together. And in our example, they may say, we're going to transact a bushel of corn at $100 per bushel. And the outcome of that is there's actually a profit or loss that could be made on this transaction, because if they agree back in May to transact at $100 per bushel in October, by the time October rolls around, corn may be worth more or less than $100. And so if the factory has to buy corn for $100 that it agreed to, and the market price for corn is only $90. I know it's a little bit hidden behind my icon here. The factory is having to buy the corn at $10 more than the market price. That's effectively a $10 loss for the factory. Or on the other hand, if corn is trading for $110 a bushel come October when they've agreed to transact, and the factory gets to buy it for $100, that's effectively a gain that the factory has earned. And so, as Americans, as we do, we figured out, hey, there's a return to be had in this economically valuable contract that provides predictability and price discovery. Why don't we apply this to stocks? Okay, so let's make it about stocks. Once again, we have a timeline. We are here in the now and we are going out into the future. And let's say that you are an investor and you want stock exposure. Well, you could buy the stock, which is the normal traditional thing that most of us individual investors, retail investors do. However, that's not the most efficient way to gain access to stocks, because if you have $100 to invest and the stock you want to buy costs $100, if you go out and buy it outright, you've used up all the cash that you have on hand, and that cash is tied up in the stock, and you're not going to get it back until and unless you sell the stock. So what did the magicians in the finance world think of? Well, they said, well, futures contracts would be a great way to more efficiently gain access to the stock market. So you could buy a futures contract that, instead of being based on the price of corn, for example, maybe it's based on the price of a stock, or maybe it's based on the price of a basket of stocks, like an index of stocks like the S&P 500, for example. And in this case, when buying a futures contract, you don't have to invest your full amount of money, the $100 that you have on hand, to get full exposure to that stock. I will come back in a future episode to talk about why this is, but generally it's fair to think about it as buying that futures contract may only cost you something like $5, $10. So you have $100, you want to buy $100 stock, you could either go buy it outright, or you could do the futures contract, which only costs you $5 up front in my hypothetical example. So what does this look like? Well, here's you, the investor, and there is your $5 bill. On the other side of this transaction, there is another investor. Maybe it's an institution like a bank or a hedge fund, a pension, could be a lot of different things. In between the two of you is just the regular futures contract that we've already been talking about. But once again, instead of having this tied to the value of something like corn, we're having it tied to something like the value of, let's say, the S&P 500 stock index in the United States. And let's say, for the ease of simplicity, that the stock index, you agree to transact in the future at a specific future date for $100. So you say, hey, bank, I want to enter into a contract with you, and we are going to say that we're going to transact the S&P 500 index at $100 on a specific future date. Well, there's infinite outcomes, but one broad category of outcome is, during the time between when you execute the futures contract and when the actual date of contract expiration comes up, the stock market has gone up in value. And now the S&P 500 is worth $110. Or another set of outcomes is that the stock market has gone down in between, and now the S&P 500 index is only worth $90. The key thing, one of the key things to understand about the benefit of this type of tool, being a futures contract, is that once this contract comes to expiration and you've agreed to exchange value at $100 for the S&P 500 index, wherever the actual real life price is, you're only exchanging the $10 difference in this example. So you're not exchanging $110 either way. Either the bank owes you the $10 profit, or you owe the bank the $10 loss. Because in this way, You wanted exposure to whatever the S&P 500 was doing, and it went up 10%, $10 over this period of time. And the way this contract was written, the bank owes you that excess $10. The other way around is that you had exposure to the S&P 500 index based on the way the contract was written. And because you agreed to exchange at 100 and it's worth 90, you owe the bank $10. But the important part is you only owe the cash difference between the two, or you only gain the cash difference between the two. And when we look at this and think about it, your outlay to buy this contract in the first place was $5. So in terms of how much cash you laid out, if you were to earn $10 in profit off this transaction, you've really earned a 100% return on the cash that you've set out. And you had another $95 left over to go invest elsewhere or use for other productive means. Now, one of the scary things about futures, and this is known as leverage, where you're essentially borrowing the $95 while only putting down $5 in collateral to do this contract. If the value of the S&P has gone down $10 and you owe the bank $10, you have to come up with $10. If if you put down 5 as collateral, good. There's $5 that you had set aside in cash available to be ready to pay the bank in the event that you owed them. But in this case, the value went down by 10 and you owe 10. So you've got to come up with another $5. So in this scenario, you've lost all of your initial cash outlay, and you're going to have to go find and come up with another $5. And when we start putting lots and lots of zeros behind these numbers and talking about huge dollar amounts that are transacted, you can see where futures are a very useful tool for efficiency, but they can become very dangerous if you are not smart and very prudent in the kind of risk that you take on. So why am I telling you about all this? Well, it is because we individual investors are traditionally mostly doing individual stock, bond, or fund investments in which we put in all of the capital we need to buy the thing at its given price. If we want to buy the S&P 500 index and it costs $100, we're going to go get the S&P 500 index fund that tracks it for $100. But there is this much more capital efficient way to get exposure to individual investments, which allows you to use your money more wisely in terms of getting the exposure you want to stocks and bonds or whatever it may be, but also having some cash left over to go get diversifying assets. We are very familiar with this concept when it comes to buying a house and taking a mortgage, where maybe we put 20% down on the value of the house, and the extra 80% that we're borrowing in the form of a mortgage, if we have that cash on hand, we can go deploy it in other productive places and leverage our investment wealth. So the next episode is going to dive into how this tool of using a futures contract to gain exposure to stocks and bonds in particular is now being more widely used and becoming more widely available to individual and retail investors, and allowing us to have a more capital efficient investment portfolio to enhance our ability to diversify our wealth across different asset classes beyond just stocks and bonds. So that really wraps it up. This is a short episode, but we will have a follow-up to this that gets into the dynamics and the details of how we can actually deploy this in our own investment portfolios and use them to our advantage to create a more diversified position. Thanks a lot for joining. Appreciate it.
You've been tuning into Sidebar with a CFP. Pierce the veil on Big Law Life, Career, and Money with Matt Smith. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, iHeartRadio, and on our website, concertplanning.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others. The contents of this podcast are purely intended to be general and educational in nature and should not be construed as specifically tailored investment, financial planning, tax, legal, or other professional advice. Any investment performance referenced is purely past performance, which is no guarantee of any future performance. Nothing contained in this podcast should be construed as an offer to sell, a solicitation of an offer to buy, or a recommendation of any security or other financial product or investment strategy. All investment, tax, and financial planning strategies involve risk that you should be prepared to bear. You are highly encouraged to consult with professionals of your choosing before taking any action based on the contents of this podcast. To the extent the guest on this podcast was a client of Concert Financial Planning as of the date of the recording, the guest was not compensated for their time. Nothing conveyed by the guest should be construed as a testimonial or endorsement of Concert Financial Planning, and their experience as an investor or a client may not be representative of all investors or clients.